Hello and welcome to another episode of Nothing Ventured with me, Aarish Shah. Today, I am really excited to have with me in the studio Laura Cornely. Laura is CEO and co-founder of Count, an FCA-regulated mobile app that positions itself as the UK's only automated financial advisor. Count builds personalised budgets, helps users create rainy day funds with optimal interest rates, and constructs and tracks investable portfolios and a financial health score. Before Count, she worked in finance and strategy at PSG as an associate, at the Hackett Group as a senior consultant, and as an analyst at Scope Group and Solar Capital in Frankfurt. In today's episode, we talk about whether understanding advice requires a human in the loop. That human in the loop, or the service, or however you want to kind of describe it, like having that handheld approach works far better. Can Count be the one app that rules them all? It would be wonderful if there was just one app that saved it all, right?
Yes,
like I think
hope so.
but that's what it feels like
Yeah.
you're attempting to kind of move towards.
Absolutely.
When does a government sandbox make sense?
And then I got into the sandbox, and that's when I knew, okay, now I can actually have proper conversations.
When can being a husband and wife team be a help, and when can it be a hindrance?
If you've been, and we've been together for 15 years, my husband and I, if you then are not
You've
good,
solved the problems, yeah.
if you're not good at communicating and problem solving exactly, then the business is the least of your problems.
How to play the dilution game.
I didn't want to dilute myself right away because I know that I need it for the next rounds, etc. You know the game. So
And is tech actually making our lives easier anymore?
I think we probably peaked about 5 to even 10 years ago.
Let's get straight into it. Hi guys, whilst I've got you for a second, I thought I'd reintroduce myself. My name's Aarish. I am the host of Nothing Ventured, the podcast where I talk to the people behind the stories that make the venture ecosystem go around. I'm also the founder of Emerge One, a consultancy that provides fractional CFO support to venture-backed tech startups from seed to Series B and beyond. If you enjoy the podcast, I would really appreciate if you could like and subscribe wherever you listen. And if you ever want to have a chat to me about anything at all, whether finance or podcast related, do reach out on LinkedIn or on X. I'm always up for a bit of a natter. Right, let's get back into it. Laura, really great to have you in the studio with me. Thank you so much for joining.
Thank you so much for having me today.
No problem. Thankfully, the studio has air conditioning because it is sweltering hot otherwise. But let's dive straight in. I want to talk a little bit about this issue of designing real advice in an app, right? So Count can automate your budget. It can put in place rainy day funds and investable plans. I'm about to download it, I think, later today. But when you substitute human advisors with in-app automation, where does that scale for access break down? And which customer cohorts shoulder the cost when recommendations misallocate capital or miss time action? And I think about this a lot actually in this kind of world of Gen AI that we're living in. And you and I were talking about this. Like, you can ask Claude a bunch of questions, or OpenAI, ChatGPT, or Perplexity, whichever, right? But actually, whilst they may surface some of the issues, it's not like it can't be advice, and you almost always will go to a human thereafter. So yeah, break it down for me.
Yeah.
Like, how does it work?
But I do like the way that you're thinking about it, because I sometimes even I say, yeah, maybe you start with a conversation with Claude or ChatGPT or whatever AI of your choosing, but do not just act on it without double checking. And so far, the reality in the UK has been that you couldn't double check because there was no one to double check with you.
Yeah.
But to the question, I would slightly push back on it to the degree that, of course, financial advisors are erroneous as well. So because it sounds like what happens.
Yeah,
if
humans
we do,
are not infallible. At
exactly.
The end of the day.
So we've been back testing our advice a couple of 100,000 times. And we had zero mistakes. And I would love to see a human financial advisor with that track record. I guess you can't find it. Everyone we know, or everyone knows someone who has a bad story to share about what happened to someone they know or to themselves about financial advice, unfortunately. So the good thing about automated financial advice is that it does follow the input to non or 0% error to give always the same output. But when it comes to scalability, of course, what that means is that if you have a financial advisor, and this financial advisor typically has 120 clients on average, then if they have 1% of error,
that scales. Yeah,
that's a difference than my solution with a couple of thousand or millions, and it's 1% of error. So the scalability here is the real question. And I guess where it becomes most relevant is less of our advice being not correct and more of how does the user understand it? Because if you don't have a human that you're talking to, like we are talking just now, they don't always understand the advice. So maybe they don't understand it's not what they needed. And I'm talking about an example that we're seeing from time to time or heard of is the zip allocation. So on top of our investment recommendation, we also give you a recommendation of tax wrappers. So which ones are the best tax wrappers for your investments to use in order to maximize your investment outcome.
And allowances,
Exactly. So if you're thinking about the zip, you kind of put the money in there and it needs to stay in there, right? Otherwise, if you take it out prematurely, it's kind of penalized. So do you really understand this as a user? Is it clear to you that if I'm putting this money as part of your strategy into a zip, that you cannot access this money as easily? So it's really more, we've been thinking about more, how do we make sure that the user understands correctly, even though I'm not sitting next to you, what is happening with your money.
And the consequences.
Exactly.
Yeah, and what are the options thereafter. It's super interesting because, you talked about, earlier you were talking about this kind of advice gap, right? So let's just talk about that for a second, right? So I'm fortunate I have, friends who are kind of independent financial advisors. So, I go to them. Not that I have much financially to get advice on for the time being, at the very least. But one thing that I have noticed, I get reached out to by people from like St. James's Place, like, there are these kind of financial advisory teams out there. And obviously no single one gives you the same advice, right? And that's the human kind of, not fallibility, but that kind of human heuristic selection issue. But equally, some of them, because the incentives potentially for them can be misaligned, right? Because they take their fees from the mortgage brokers or from the ISA providers or whoever, right? So if they sell you a product, they're getting a fee. So it's in their interests potentially not to sell you the most appropriate or best product for you, but because they have these affiliate kind of accesses, they'll push on you what is most expedient for them. Is that something that you are able to, I guess, avoid, right? And therefore provide the best advice in all circumstances to your kind of customer base? Or like, how does it work, I guess?
Yeah, we are independent. And so we don't push products just because we are getting a commission on them. That's mostly not the case in the UK as well, actually. So the whole regulatory background that the FCA changed dozens of years ago was to the goal of avoiding that exactly this is what's happening, that they're recommending something that you don't really need just because they want the commission, which is unfortunately in Germany still the case. Okay. So the structure of how they're being enumerated is different in the UK. So we don't have that because the way that our pricing works is just a subscription and then assets under management fee.
SaaS and,
exactly.
Okay, fine. Okay.
So that way we were able to include into our investment universe all of the available ETFs in the London Stock Exchange market, and then our algorithms work on this pool. And it doesn't matter which one is the one that would potentially work up with us or do a cooperation with us, which we don't. But it's honestly about the portfolio construction is automated just as the nature of our advice, and hence it will not push anything on you that doesn't work for you.
That's super interesting. So like for someone like me, right, who's lived in different places, came back and kind of took a bit of a scattergun approach to kind of all of this. So let's say, my wife and I have ISAs set up. My kids are probably one has an ISA set up, the other one is setting it up, having turned 18, and some savings here and some, whatever here. Like, but equally don't have the time necessarily to spend trying to figure everything out, right? So like everything is sitting in index trackers or whatever, or just in a interest-bearing account. Am I kind of ICP for Count, or is it even like for a layer below that where just I have nothing and I don't know what to do?
Yeah, it's interesting. Just in general, I think there are so many instances where we think about, okay, who could use standardized financial advice, and these are the typical people that just don't have the time, as you said. Even if we are financially savvy, which most people unfortunately aren't, then half or 80% of them, again, don't have the time. I myself am like this. Everyone who works in a very demanding job, we also have a life that we want to live. So
we often outsource it to others, and typically like we outsource it to the government or the pension regulator or whoever, right?
Yeah, exactly. So if you just want to have someone that then manages that for you, that's where Account comes in handy. But it also is for the people, if you're thinking about that, don't have an understanding of finances. So I'm talking to these people every day because as a founder, I want to be very close to my users to understand the struggle. And I'm hearing the top things I'm hearing is, I don't know what to do.
Yeah.
I honestly don't. And that goes through all ages. So I would have, at the beginning, I thought most people in my age and, the millennials.
Or my age, late 40s, whatever.
Exactly. Yeah. Our peers would be our ICP. But in reality, I have people also in their 60s that I'm talking to, late 50s, and they are just as confused as everyone else is.
Yeah. And it feels like, certainly here in the UK, without turning this into a kind of political debate, that we have some real crunch times coming. Like we have a very clearly kind of obviously aging population, but we're going to go through for the first time, I think, next year, population decline where the death rate is exceeding the birth rate, and net migration has plummeted, is falling quite considerably, despite maybe what what some people would want you to believe in the news. But what that means, and I think about this all the time, and you have people like me who are actively, because we are mobile, because we have had relative success in our lives, and because we essentially have been migrants, first from India to Kenya, from Kenya to the UK, and then I've lived in Papua New Guinea and Australia. That mobility sticks, and I've been actively telling my kids, well, maybe you want to consider building the first part of your career somewhere else, because the next 5-10 years here in the UK might be quite difficult. But all of that leads to, and by the way, I'm massively pro UK overall. I just think we need to fix some stuff, and I can't see who the hell is out there trying to fix it. But my point more broadly is we're going to come to a place where, and most people, to your point, are not financially literate, certainly in this country, if not elsewhere. And so, for your average Joe, the assumption is, well, I pay my taxes and that leads me to getting a pension when I'm 65. Yeah. Of course, you pay your taxes in order that the person who's already 65 can get a pension, right? But we are walking into a place where in the future, certainly from a state pension perspective, we are going to have not enough people paying in for those that need to take out, right? So I guess, is Count, I guess, an attempt to, whether consciously or just implicitly, or an attempt to hopefully help this 100%. Next generation of individuals get to retirement without feeling like they've got a black hole underneath them.
I sure hope so. So one of the things that always come to my mind when it comes to what happened in the financial space, the consumer fintech space, is that we had a lot of this, technology and innovation that happened, which is, of course, nice because it's more transparent and it's cheaper now. If you think about how it was for our parents, it was probably like you went to your banker. And your banker knew you, they know your family, they know the situation. And then based on their own capabilities, hopefully they're good, they would give you your financial strategy, and that works, hopefully. And then all of this innovation came in. And as I said, they had the good perks of making it transparent, etc. But what they also did is that they fractured this experience. And here in the UK particularly.
Oh, it became incredibly fragmented, right?
Yes, okay, exactly. Sure. So you have apps for your current account, your savings account, maybe a trading or a robo-advisor. Then you have the different tax wrappers. You have a bazillion pensions that no one knows what's going on. That's another issue that I'm hearing all of the time. I don't know where my pension is.
Which is why Pension B has been so successful in the UK, because they just easily consolidated.
Absolutely. We are rolling out in the next quarter pension consolidation as well, because it's just so helpful to have everything visible, so you understand where you are right now. And that is what we're trying to ultimately solve. I want to bring it back together.
Especially in a world where, people are not working 20 years in the same company. So, you spend 2 years here, build up a little bit of a pension there. You spend 3 years there, the same thing happens, and you lose track. Like I certainly did, right? And when I came back to the UK after 10 years overseas, like the 4 or 5 years where I'd worked and had some sort of pension contributions being made, they were all over the place. So from 3 or 4 different organizations. And again, because I didn't want to think about it, I took the most simple path, which at the time was, okay, pension B, bring it all together. I'll figure it out down the track. Like at the moment, that just keeps it in one place, happy days. And then ISAs and then this and that. And I think to your point, right? So I'm someone that obviously uses technology a lot, but have a lot of technology fatigue. So my bar for downloading an app or using another product is massively high. If it is going to force me to do something outside of the stream or does not kind of consolidate what I'm already using in a better way or whatever, like it's really hard for me to say, okay, I'm gonna get that app. And it's really frustrating because exactly to your point, I have an app for my mortgage, I have an app for credit cards, I have an app for, you know, whatever, this bank that I'm using for this and that bank which I use for something else. And I think this is true even in just, you know, the general market of, and why you have, you know, compare the market and money saving and all of those sort of apps and websites and platforms out there, is because people are now getting decision fatigue because, or, you know, essentially it's this paradox of choice. Like the more choice you have, the more overwhelming it is, and therefore the less choice you actually make. It would be wonderful if there was just one app that saved it all, right?
Yes,
like I think
hope so.
but that's what it feels like you're attempting to kind of move towards.
Absolutely. Yeah. When we ventured out to building what we're building, we had a lot of conversations about what people are actually looking for. And this, what constantly came up is, I have no idea how much assets I have.
Yeah.
Which is literally what you just said as well, because they're in so many different pots that we absolutely have no idea how much it is in total.
Yeah.
But we also don't understand how they're performing for us. And we also don't understand how much we're paying for them. If you have 6 different pensions with 3-4 different pension providers, then you don't know what the fees are, and you don't know what they're doing also. So you have zero visibility, and bringing all of this together in one app where it tells you this is how it's performing and how much you're paying on it and what it does for you also over the long run. We also have projections. Yeah, that's I hope going to alleviate a lot of the pain.
Yeah, because most people just don't know what this means tomorrow, which is essentially what it is, right? I'm pretty much sold, if I'm honest. No, but again, right? Like, I mean, I maintain a spreadsheet. I have a handle on.
I love a good spreadsheet.
Yeah, well, I mean, finance, like sadly, that's the world we come from. But right, you know, a spreadsheet tells you what you have. It doesn't necessarily, it doesn't tell you what you should do, right? It's a great way for me to track. And I do it daily. It's become kind of part of my mental health routine, is just, okay, let me just make sure I know where everything stands. But it's also, I guess, it's sort of almost like a bit of procrastination, where it's like, okay, having done the spreadsheet, I've done my job, rather than, okay, no, am I maximizing what I need to be maximizing in the right way? And I actually think, by the way, the other obvious use case, if I can put it that way, is, you know, people like me, right? Solo founders, you know, running a business, just, you know, no time to do anything. But equally, you know, finances are messy. You know, people have to figure out, okay, how much should they draw from the business? How much should they take out in dividends? How does that all work? All of this sort of stuff. I would imagine there are lots of people in that kind of boat who kind of got in, like they set up their business because they're the best marketer in the world, or they are, you know, they have access to the best, I don't know, material in the world to make sofa cushions, right? They didn't think about going into business to manage their finances, and predominantly that isn't what they're good at. And it feels like this, you know, at least at a personal level, hopefully starts alleviating some of that pain.
Yeah. I mean, we are as I call it, standardized. We can do a lot, but it is, you have to see and figure out whether it does work for your life situation. Yeah, sure. So if it's very complex, and that's probably back to your initial question, where does scalability not work anymore? And I guess that works, or where it doesn't work is for complexity. Yeah. Which is probably, and interestingly enough, why we are not interesting for the high net worth individuals, because all they have is complexity. They have the properties, they have the offshoring, et cetera, et cetera. So I really didn't build for them. I really built for...
But to your point, they're the guys that have the access, right? Yeah, like, so they have the planners, they have family offices, they have a variety of options available to them. And therefore it becomes self-managed. But that is not 90 whatever % of the population. Right?
Yeah. What I found interesting while building and understanding the market more and more, you know how founders are. Ultimately, they are the biggest experts in their own market. And that happened, I like to think that happened to my team and myself as well. What I noticed is that everyone is just trying to sell you a product, and which is a bit of a shame. And I think that's not very up to date anymore with the younger generation.
Yeah.
So we are trying to sell you a service rather than a product.
Yeah.
I remember the first time I checked out one of my competitors, and I'm not going to name drop or shame anyone here, but I went on their homepage and I clicked on the burger menu button, and it just unfolded like this
30
long, oh my God, catalog of products. Do you need this, 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 this? And ultimately then again, you are just standing in front of and you're like, I have no idea which one. Can someone please help me? So I'm really, I took a different approach to what I'm building. It's not just selling a product, it is selling convenience and peace of mind.
Yeah, it's
sounds
almost
a bit cheesy.
No, it's concierge. No, but also I think that was a fallacy with a lot of the kind of fintech apps is, yes, they were brilliant and opened up a whole market to, you know, of people who didn't have access, but also education, right, in that and knowledge in that sort of market. And so it opened it up. But then you had stories in the US of, you know, people starting to trade on margin on some of these apps and then creating massive losses, which, you know, sadly ended up in really tragic kind of outcomes. And it's because they just let the user get on with it. And I think for something as complex and complicated and as important as financial advice and management, that human in the loop or the service or however you want to kind of describe it, like having that handheld approach works far better, because I can tell you, even myself, well, I can certainly speak for, you know, argument's sake, my wife, right? If you were to just give her an app and say, get on with it, she like, that's not her. She's a creative person. You know, she doesn't love numbers. She doesn't love, you know, trying to figure out, like, if you know, in an ideal world, I would have a job, I'd pay tax, we'd pay our mortgage, and life would be hunky dory. Sadly, I've made her life very complicated. But, you know, I think a lot of people want to have the comfort that, okay, I'm being not told, right, not condescendingly, but I'm being pointed in the right direction. And I have some confidence that the advice that I'm getting is from the right place and is, you know, intended to maximize value for me. And equally, by the way, not, you know, maybe it's not the advice that is gonna make, you know, the 10% return. Maybe it's an 8% return, but that's still better than zero. Yeah, right?
Agreed. Yeah, I was honestly quite mad at the market situation when I just saw, okay, no one is really helping anyone. And the only reason why no one did it was, I'm pretty sure it's because they were too lazy to go through the FCA. Because it is a costly, of course, you have to have the right skill set in terms of your team. So people need to understand what you're going, you know, building. And then the FCA has to play along as well.
Yeah. Well, let's talk about the FCA, right? Yeah. So let's talk about the sandbox and what it does and doesn't enable, I think. You know, you've described the sandbox as occasionally confusing, I think. But you said the experiences really do vary by kind of the case manager. But for founders that would be considering the sandbox, when does that promise of product velocity flip into regulatory overhead? And which founders should avoid it because it'll constrain delivery? And I guess the caveat to all of that would be, but you know, if you are intending to build in an FCA regulated space, then why not take advantage of what's out there?
Yeah. Oof. This is a very complex question. And so what I meant was, in terms of confusing, is that the FCA is not doing a fantastic job in communicating what the sandbox does, how it works, etc. Even if you go, I remember before I started the product, I went to the homepage and I checked it out and tried to understand. And I you know, afterwards I was just as informed as I was before. So they need to, I know they are working on that for sure. When it comes to for whom it might be interesting, that really depends on the product.
Yeah.
I mean, I'm B2C and then I'm the first in what I'm doing. So I've talked to probably 20 other founders that went through the experience and no experience was the same. If if it was consumer facing or in general, I would say as a founder, potentially is smarter to ship your product, some form of your product. So you start and you can build out whatever it is you ultimately want to get to, and then do the FCA authorization process parallel to it.
I mean, so I think it's fair to say, and we've had, again, this conversation on the podcast, right? Whether it's this government or any government, right? Like, I think there is this communication gap just generally across the board in terms of what they're doing, what the intentions are, where the value sits and who it's for and so on, right? So, I mean, like, one message to the government, please communicate better. I think a lot of us would be a lot happier if that were the case. And you know, I think, but, you know, when it does things well and gets things right, it can be a real accelerator, right? And so, you know, from my perspective, I mean, I haven't worked with a ton of regulated fintechs. We've worked with maybe one or two, but it feels like every edge you can get, you should try, you know, you should try and take advantage, because in theory, the sandbox is there to improve, right? How the FCA or how the regulator and how the government in general approaches both innovation, but also value to the population, the electorate at large, right?
They should note that down.
Yeah. Hey guys,
Yes,
I'm
please,
available.
please take notes.
If you want some copy written, I can do that. But no, so I mean, I guess the question, like, you know, the obvious question then for you is, are you happy you went through it? Like, has it been valuable for you?
For us, 100%. Yeah. Otherwise, we would have been another consumer-facing fintech app in the market, and now we are, you know, the first, the only to do what we're doing. Of course, now they are starting with the targeted support approach in order to kind of get people into investing. Right now, they're having a campaign which has this awful squirrel. I don't know who came up with the squirrel. I don't know whether you've seen it. It's just frightening.
Okay.
So
are they trying to like squirrel away your cash for the future acorns? Is that what I mean? Like,
yes,
I don't know.
exactly.
Okay, fine.
So they did consult you.
Yeah, clearly. I would not have recommended the squirrel.
And it's so AI generated. It really is AI slop. So anyways, it's to me, I know they're trying, but they oftentimes try something and it stops in the middle or it doesn't come out one way. But ultimately, the idea of how the sandbox operates is that you can get started with something rather than going through the full authorization. If you think about it as a startup with 5 people, and you need to have another 5 people just in order to, be sure that all of the regulatory thresholds are met for you, then you might as well not start.
Yeah, it's going to be too tough, right? Yeah, no, look, I mean, I think, and again, look, I mean, one thing that the UK excels at is fintech, right? Like it always has. Yes. I mean, the City of London has always been this fantastic breeding ground for fintech, and we have like some obvious and well-known success stories in the UK, and hopefully many more. And I would hope that Count Finance is certainly one of them.
Yes.
But yeah, I think, I think there is always a balance between government intervention, regulation, and how they fund or even promote innovation, right, within the ecosystem. And I think, broadly speaking, those that I know that have participated in a variety of different sandboxes, but certainly the fintech kind of FCA sandbox, overwhelmingly, it's been a positive. Whether or not the experience has been positive, the usefulness has been positive, I think. And that's always, that seems to shine through. Yeah. No, amazing. I want to switch tack for a second. And you and I had a massive, I wouldn't say it was a massive debate, but we exchanged thoughts on this. And that's on being part of a husband-wife team.
Yes.
Right? So you have led with being a couple whilst fundraising. And said that some investors explicitly rejected couples. And I think, as I mentioned to you, that would have been one of my kind of uninformed heuristics as well, maybe, or less informed heuristics. But at fundraising, do you accept that disclosing the relationship and losing access to some investors is positive, or do you conceal it to preserve access and accept the later signaling governance and career kind of fragility costs? I mean, basically, we've had we've had VCs and we've had founders that are part of kind of husband and wife teams, etc. And I just find it as a really interesting dynamic because I think, someone who sat kind of both sides of the table, as it were, I understand why actually having a co-founder who is your partner and your life partner could be a really incredible thing because, they understand the emotional toll and, the amount of work and effort and joy and tears and emotion that you have to pour into the business. But on the other hand as well, like, if you both have a bad day at work, does that spill over into the home, etc.? So yeah, no, look, would love to get but make the case either way, I guess. Yeah.
Yeah. It's so dependent on the couple, I guess, right? And when it comes to having the funding conversations, I would say it depends on the founder. Do you want to min-max your chances of success, or are you in for the long run, which is what I am? And so I led my conversations with, hello, my name is Laura, and this is my co-founder / husband. This has always been my first sentence. And then maybe, no, we're not siblings, even though we have the same surname. And it's always weird to have someone ask us whether we are siblings, because I think we don't very much look alike. Right? So I rather be perceived as husband and wife rather than siblings. Yeah. So yeah, I took it with a bit of humor and being proud of it. And ultimately it paid out for us. And I wanted to have investors that like us as a founding team. Sure. And understand the merit of us having very specific skill sets that work well together in what we built. Yeah. So that's why, in my case, I say it paid out. For others, I wouldn't say it's not always the best strategy to do.
Yeah. So I think I have so much, as always, to say about this sort of stuff, right? Like, I mean, I come from a family business background, and actually, in our family business, it was actually all down the male lineage, although that's now changed over the last 10 years. But our wives were not participants in the family business, albeit probably the backbone of it, right? Because, we shipped off to, as I did, Papua New Guinea, but it may have been Uganda or, one of my cousins' instances, Angola and various kind of backwater type places. And, without the incredible support that our wives provided for us, that would have been incredibly difficult. Equally, equally, I think when I'm thinking about startups, right, like the thing that I think probably deters me or deterred me, and I think having met you, I haven't met your husband yet, and I guess I should reserve judgment until then, right? But the thing that really kind of struck me is, so I don't love it. So I definitely don't like it when a founder hides it or is not open about it, because
right away. Because maybe you get to the second conversation, but that's probably the last one.
Yeah, I would rather know upfront and early than down the track and feel like I've been sort of lied to. But more so, the UK. I can't remember what the stats are, but certainly, like, the average founder VC relationship, as I've said many times on the podcast, lasts longer than the average UK marriage, right? So therefore...
Is that true?
Yeah. So therefore, husband and wife getting into one of the most difficult kind of things that you could ever attempt to do in your life, building like a highly scaled business, is going to put pressure on what potentially could be a fragile or lead to a fragile relationship. And I think, if that then happens, there's a divorce and it's acrimonious. Well, what happens then, and how do you deal with like the shareholding? And, we already know that co-founder breakups can be one of the biggest killers of startups. Well, imagine if that's husband and wife and so on. So how do you and your husband protect both the business and your relationship in the best way, whilst getting the best out of both situations?
So I always thought, but probably not. It's not the case for every couple. If you've been and we've been together for 15 years, my husband and I, if you then are not good,
you've solved the problems. Yeah.
If you're not good at communicating and problem solving, exactly, then the business is the least of your problems, yes. So I would assume that most couple founders, if they've been in a longer relationship, are probably better at handling the business together than most founders, which typically founders, if they partner up, they haven't been working for too long with each other. And especially
or certainly not as founders.
Exactly, especially not in that capacity. So I would reckon that they are struggling more when it comes to these kind of things. On a personal level, we had to learn a lot not to talk about the business all the time. For investors, of course, that's nice because they know, okay, they are always talking and always thinking about the business. For the relationship, not so much. And we're still figuring that out. So Sundays, I would love to say all of my Sundays are without business conversations, but even they aren't. And then at dinner, at lunch, et cetera. But we just love it. So we love the space. We've been working in the space. We love the space. We love the product. We love our team. So I don't mind it that much.
It's a shame. Yeah, no, look, I mean, I think that's wonderful, right? Because a lot of couples, especially as they grow, potentially drift apart because their interests kind of fade or go in different directions. But you constantly have, a central interest that binds you. I don't actually think there's anything wrong with, bringing. I mean, I think if you have kids and you're doing it and the kids are there, that's maybe a different matter. But I think as a husband and wife, if you're talking about this thing that you are building together, that hopefully strengthens as well. And, to your point, I would tend to agree. If you figured out how to have reasonable, rational conversations without bringing the emotion into it, then that can only be a positive for the business as well. Because, I think I've seen it many, many times, and certainly within a family business context, it's emotion that actually is the biggest problem, right? Like, the issue that we had is how do you sack your cousin, right? Like, I guess is the thing, right? And without looking like you're sacking your cousin, right? But I think also, it's also to an extent having the humility as co-founders that your roles within the business will change, will evolve, and may even end actually at some point, right?
And we discussed that right at the beginning. So we discussed can it develop? Are both of us fine? Who is the one who ultimately does the decision? So that's why I'm the CEO, because ultimately, even if we don't agree on something, I can just say, okay, but we're doing it that way because I said we're doing it that way. It's not that I'm not listening it, but after talking about it, someone needs to be the one who
has to be a path.
Yeah, exactly. And then in terms of how we handle the team, obviously it's also nice because you have someone, and I'm sure you had that with your business as well. If you had others involved, you do trust your relatives, or in our case, husband and wife. You trust each other so much. So, and your employees can feel it. They see it, hopefully. I have to ask them, I should. But they can see it, and it's a different work atmosphere, I guess. If you cannot divide your founders in conversations and they're always pulling on the same string.
That's interesting.
I think that's, in our case, it was very helpful already.
I think you should do an NPS. Maybe check with the employees. How is it working for mum and dad? But
it does feel like that sometimes.
Yeah, I mean, like, as you were talking about it, I was like, I can see where this is going to go. And look, but it's also interesting, right? Because a couple of the conversations I had with and actually this was like way back in when I first launched the podcast, right? So one of our clients was Omnipresent, which 2 German co-founders. And they had co-CEOs, and they were telling me that that's a very common thing, right, in Germany, whereas it really isn't certainly in the UK, probably not in definitely not in the US either, right? And actually, with a husband and wife team, if you've already fixed that kind of ego issue, then it's a much more you're not vying for each other's job, right?
Exactly.
Which often, and I've seen it again with co-founders, there can be constant tussle, right? And depending on your board, they may even have, an opinion and approach. And one of the things I've always told founders, right, co-founders, is you've got to be able to disagree in private, but agree publicly, right? Like, you have to have a united front.
Like with children.
Like with children, 100%, definitely. My wife and I haven't figured that one out yet. But the point of all of that is then that as a husband and wife team, I guess to an extent that's easier because you can have you don't have to go off to another husband and wife, have to live your kind of familiar life whilst also having this co-founder relationship on top. to an extent that maybe makes it easier. I guess the real challenge is always when a challenge arises, right? Like, the only test will be the first test, and then whatever happens thereafter. But
I won't say it was easy all of the time.
Okay.
Especially at the beginning, but it really is now.
I can imagine, right? But because at the beginning everything is chaos, right? You're just everyone's trying to figure out everything. I would say that you have, since first talking to you, you've definitely improved my thinking.
That I'm glad to hear.
On the issue. So my lines are no longer black and white, put it that way.
For investors, I will say at least take the conversation. Even if you see it on the deck maybe or in the surnames, at least take the conversation. And then it's a lot about gut feeling as an investor as well, right? Do you like these founders? Do they make, because I've been an investor for the longest time in my career. So do you like them? Do they understand what they're doing? I oftentimes had conversations where I asked, and I was always a generalist, I asked a bit about the market, and I didn't have a feeling that they understand their own market. They're the typical red flags. So it should not be dependent on whether they're a couple or siblings or whatever.
Yeah, you're completely right. Like, if all the literature, all the kind of conversations that precede and seed, any investor is going to tell you they are primarily investing in the team, next to which they're investing in the market stroke.
Exactly.
And potentially not even the product at that stage, right? And I had one investor come on and say to me, like, if the company hasn't pivoted 30 times, like, is it even a company, right? Like, is
okay,
it,
well,
right? Yeah. So you gotta get up there, right? No, but especially within B2B, I would say that's often the case, because you start off with a core thesis, and then as you go into more customer discovery, it becomes more and more clear. But yeah, look, I think investors are looking for people with ideas, stroke products, with a large enough market that they're going to make a decent return. And if you and your husband are the right people versus you and another co-founder, or two completely separate co-founders, or a solo founder, or whatever it is, then that should be on the table, and should be evaluated as everything else will be evaluated, right?
Yeah, and we are very happy with our investors, so ultimately we got there.
Excellent. Let's talk about funding, right? So funding in 2026, especially in funding in fintech specifically. So you raised relatively recently. First half of 2026. For consumer fintech founders, when does taking larger venture capital to buy time and market share become a failure mode that erodes the discipline and product market fit? And when should founders choose smaller raises and tighter unit economics instead?
Yeah.
And I think this is fundamentally like a market shift question, because we've very clearly gone through that shift.
Yeah, I agree. And I thought about that long and hard as well with the current raise. And as you said, so it really does depend on the market that you're in. When I was still, so before I started Count, we were or probably even more before Corona, we were in this market where everyone had so much money. Yeah. There was so much money in the market, and they're just handing it out. So founders were very much used to, I don't have to think that hard about the next.
I can raise again.
Exactly.
Yeah.
And then
I literally had a SaaS business in the loyalty space.
Yeah.
And I was talking to him, we were pitching him to potentially work with him. And I asked, how much runway. He goes, I'm not really worried about that. I'll just go to the investors and raise again, right? Yeah. And this was probably
cool story, bro.
yeah, exactly. This was like, but at the time it was like it may have been 2019, or if not, it was 21 or 22. Like, the money was there, right?
Yeah, exactly.
Yeah.
And then the multiples were super high, and everyone, even after the money was then nearly spent and you had to raise again, it was all about the growth rather than lots of the difference. So if you had the growth numbers to show, then no one really cared anymore, honestly. Didn't really matter whether you're a good founder, if you did a good job with your team building or the product or whatever the product. Oftentimes, I know that they didn't even take a look at the product.
Yeah.
Or we wouldn't have invested in some of the stuff we would have invested in. And so, that changed with Corona, and especially also then the Ukraine war, where all of a sudden the market came down, no more money left, valuations came down, and then suddenly all these founders are standing there and just like, but I need a bit more money, please. And then most importantly, the KPIs changed, right? It wasn't about the growth story and the scale. It should be scalable for most investors still, of course, but it's not, you have to deliver now. Profitability has been a word for the last 3 years that was never in the conversations before.
Growth at all costs doesn't matter. I mean, like I saw a post from friend of the podcast, Chris Smith at Playfair Capital recently. And I think he was saying, you know, expectations at Series A have moved from 1 million to 3 million, right? Like as in you now have to have that traction, revenue traction. And again, probably depends a little bit on sector, etc. But you have that traction. And yeah, for sure, like I think for very R&D intensive businesses, you can still get away with being loss making, right? Like, and clearly that's going to be the case.
But it's also very hard to raise.
But it's hard. Well, it's interesting, right? So what the numbers would seem to show is that there's phenomenally fewer. So there's probably about 50% fewer deals at like seed being done, but the same amount of capital, which means fewer businesses getting funded with more money, right? So there's that concentration.
Exactly.
And so therefore, as a founder, I think you've definitely got to think. You've got to think about, okay, you should have been thinking about this anyway, right? As a founder, is this truly a venture scale business? Is venture the right financing option? You know, I still remember when you could go and get a bank loan, right, to build a business. Like, and some businesses should be doing that, right? So, but like, so how did you?
Agreed, and I think founders in the last 2-3 years, they had to become very, how do I say that? Yeah, think outside the box on how to run their businesses. I mean, I bootstrapped for the first 1.5 years as well, not because I couldn't get capital, I could have, but the valuation was so bad. And I didn't want to, exactly your question, I didn't want to dilute myself right away. Because I know that I need it for the next round, etc. You know the game. So for me, in the current round, it was very much a formula out of how much money do I need to be able to concentrate on execution? Yeah, because that's right now my most crucial part. And how much do I not want to dilute myself? So these were the two aspects. And then the third one is how likely am I going to be able to raise again, which of course is to some degree related to the execution, right? Yeah. So these were the things that I would recommend for founders that want to raise to think about.
I think on top of that, there is also just, there's been a slowdown in certainly consumer investment.
Yeah.
Right.
I started building. I was like, how hard can it be? It's B2C fintech. Everyone loves B2C fintech. And I came to the market and I was like, oh, hell no.
Yeah. I mean, look, I think it's tough across sectors. And again, we talked about it on the podcast before, but, you know, certainly in the UK, the where investment is traveling is AI, obviously. Yes.
Deep tech, AI. Yeah.
But life sciences, fintech, and anything defense, sovereignty, you know, related, like anything, you know, supply chains, hardware, you know, energy security, all of these sort of hot things, right? Which means, you know, that the spread of the money changes, and therefore actually the pockets of capital available to each of those sectors changes. Whereas fintech was the obvious darling of the UK for many, many years, and still is, right, to a great extent. But potentially there's less capital flowing into it, and potentially how that capital splits between consumer versus B2B versus whatever. I mean, I think, you know, where we see, you know, success stories like Revolut, hopefully that, you know, that kind of engages the market again, and you know you're going to have a lot of investors that came in the crowd round becoming millionaires off a £5,000 investment or $5,000, and that's really incredible. But as a founder today, raising, you know, I how long, out of interest, how long did the fundraise take?
Half a year.
6 months.
Yeah. And that's currently what people tell you what it will.
Yeah. So
take.
6 months, product was in market.
Kind of.
Okay. Yeah. But you had some like early.
It was a beta.
Okay, fine. So you had some early kind of users, etc. In the sandbox already as well?
Yes.
Okay, so the FCA kind of part, you knew that
exactly.
How
so
that was
I got into the sandbox and I was like, okay, now I can actually start having this conversation, because before that, all I heard, because of course I build up my network as you should, because warm introductions are basically the only thing that work. It's another note probably for other founders. So I was building up my network, going to the events, having these conversations without actually raising. And then every time, no, you will never get through the FCA. Never.
Just the assumption was it won't happen.
Exactly.
Wow.
And then I got into the sandbox, and that's when I knew, okay, now I can actually have proper conversations.
And unlock, yeah. I mean, look, so the advice we give at the moment is 4 years ago, 3 to 6 months.
Yeah.
Today, 6 to 9 months.
Oh, wow.
To do a price. So again, depends on when and what stage and all the rest of it, but like it can take time. You of course have some investors, and again, stage dependent, who will still write checks with 4 or 5 days. But I think the other thing that's happened over the last 3 years is I think a lot of VCs got caught out on the lack of diligence that they were maybe doing on some of the businesses that
Especially
they
on the
underwrote.
founders.
Yeah, well, precisely. And so that diligence requirement has definitely increased of late, right? Which is why you also have these slightly more extended timeframes.
Slightly.
Slightly, yeah. But 6 months. But this is a problem, right? Because you went from a world where you would raise 12 months runway, and that would be sufficient because maybe it was 12 months you could stretch to 18, and you go out and raise with like 3 or 4 months to spare. Now you've got to raise 2 years because you might be fundraising within the start of the the first quarter of your second year, right? Like it's the calculation has changed, and I think that whole balance then is how you show velocity as a startup without being overly cautious. And to your point, right? Like profitability is great, or certainly cash break even is great, but it hinders your ability to scale, grow, right?
Exactly. Like it's a balance between the two.
So I think it's it's both an incredible time to be a founder, but also that balance can be exceedingly difficult. And therefore, I think what we have seen and will see a lot more of is also the so-called seed strapping, where you just raise around and like get to that kind of profitability and then just write your own destiny. But I think also VCs are to an extent cottoning on to the fact that often those businesses are not going to scale out to venture size returns. And that's where the challenge then becomes.
Yeah, that's why they oftentimes ask you the question, so where do you want to be in the 5 years? And how do you see the future of your company? If you understand where the money is coming from and what the intention is of their investments from the investor side, then I think most founders know how to answer correctly, even though they probably don't mean it always like that.
Well, the answer is, I mean, like I've had this question, asked this question, been with founders when they've been asked the question. And I think the most sensible answer is we'll see. Like our intention is to grow this into a substantial business.
Yes.
It's kind of tied to that exit question, which is like important, like who's your exit? Well, could be literally anyone, right? Like,
thank you.
Please.
That has always been my answer because it is. It
could be a strategic, merger, it could be private equity. Okay. I could
IPO.
Like an exit. And by the way, I mean, that whole exit question, sorry, this is now a bit of a side rant, but that whole exit question is immensely dumb because an exit is not an exit, right?
Yeah.
Like I think people conflate exit with liquidity, right? An exit essentially means that you've gone through a liquidity event that either shareholders have changed, right? So you've had another business buy you out, you've IPO'd, and therefore you've gone public, and therefore it's now traded, or you've got a private equity firm that will buy it out and give liquidity back to the initial investors. The business still has to persist.
Yes.
Right?
You cannot just build a business until that exit.
And then leave. Right? Yeah. And
I mean, you can, and it worked for some people.
Yeah, but rarely, right? Like, so for most people, an exit means a different boss, a different set of shareholders, right? Like that is ultimately what it is. And therefore, actually, the response has to be the right, when the right opportunity comes along, that's when we get it. And equally, like I know people who, raised back in 19, 20, whatever, marketplace business, let's say, that's fallen out of favor. They're now kind of profitable, or at least, at least not losing money, let's put it that way. And now they're thinking, okay, in the next 1 to 5 years, what happens, and do we find an exit, whatever. But equally, okay, well, if you can build a profitable business, then a dividend flow for some investors might be sensible. So if you decide on what shape of business you want, you also decide on the shape of investors.
Yeah. But yeah, that's not what they want to hear most of them.
Of course. I mean, like everyone wants to know we're going to exit for
it's going to be the next unicorn.
100x, right? But this is also the interesting thing, right? Like at early stage with angels, I think they're much more accepting of it could be a 5x exit or they'll be taken out by secondaries at Series B or whatever, right? Like they don't have, at least with angels, they don't have that need to return the fund, right?
Yes,
which is obviously what VCs are looking for.
Yeah.
And
it's different conversations. I think they are looking more for the businesses that are being built to prevail.
Yeah. And I think that's exactly it. Like what has longevity in this sort of a market, and especially a market that is changing at such pace. Laura, this has been an absolutely phenomenal conversation. I want to end with a couple of questions that we ask all of our guests.
Yes.
So what is one thing that you have a contrarian conviction about from any area of life, whether that's work, politics, socially, or at home?
Interesting enough, you already touched on it to some degree. So now I know you probably think the same way. And that is that I think that technology is not making our lives easier anymore. I think we probably peaked about 5 to even 10 years ago, where it really was this, and it still does sometimes. It brings this freshness, this ease, and makes your life nicer. Yeah. But that mostly changed. And now it's more of a making your life a lot more, less human. Oftentimes, if you think about now, I cannot just book a table anymore anywhere here in London. I always have to go through Open Table, and then it's limited to 1.5 hours. Thank you very much, Open Table, for that. Or if you think about anything that is password related, if I have to do one more multi-factor authentication, I'm going to lose it. So instead of making our life easier, that did bring a lot of
it's a technology tax, right? Essentially, your behaviors are forced to change.
Yes.
I mean, the one that I'm seeing a lot of at the moment and just detest is the AI email responses, like where they're actually not unsolicited, like actual replies. And I think a lot of people are kind of outsourcing their thinking, not actually looking at what's being said. And, you know, as a human that receives it on the other end, you will then make judgment because you can see what's been done. And actually, I think the cognitive load, therefore, is increasing because you're having to pass so much more information, and often like information that may be suspect because it hasn't been, hasn't been vetted.
But also for chatbots, for example, or customer service, the disrespect of companies of just putting an AI chat voice on the other end of my line if I want to connect with you as a company. That goes back to what I've been saying also. They just sell you a product. You know for sure. Yeah. One of the worst examples, of course, is something like, I don't know, Ryanair, where it's impossible to talk to a person or whatever.
And it's the only way we can fly anywhere in Europe. Yeah, sure.
So it's so disrespectful to another human as well to do that. And I'm having, as I said, these conversations, and everyone that's speaking to me at the end of it is like, oh, this was so nice actually speaking to a person right away. So I will keep at it because it is ultimately, I always saw technology as this beautiful thing that helps us, thrive as humanity.
It should be an enabler, not a
exactly.
blocker.
And right now I'm just annoyed by it.
Yeah, look, I mean, as a CFO, out in New Guinea and Australia, a decade and a half ago or whatever, one of the most wonderful things was that I had relationship managers with all my banks. And we had bankers who, we were doing asset financing and term loans and property financing and all sorts of stuff. And, yes, we had we had our difficulties, but like it was a human being that I met, and went for a drink with or dinner with or lunch or whatever.
If something comes up, you pick up the phone.
Exactly. And now I came back to the UK and I had a relationship manager in my bank, and then they got rid of them. And they got rid of that sort of layer of interaction. And that is massively frustrating because like some of these decisions are massive decisions, right? And you want to be able to talk through with someone that's competent, right? At the very least. And I agree. I think the clapback against tech for me is too many apps trying to do everything. And that just makes my life more complicated, not less. And I think the lack of personality, again, I've said this on the podcast before, I've been asked, why don't I turn this into an AI podcast? And I said, because that would absolutely kill the value that I feel it gives me, let alone what it might give others, right?
Yes.
But the value for me is that I get to sit here
Yeah.
and speak to a human being for an hour and a half. Whereas, if it's an AI podcast with the same voices that everyone else is using and blah, 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 that just feels like
Empty.
very empty. I think that's hollow. Like that's exactly what it is. And I think we're actually now starting to see that, by the way. I think people are starting to have this response to too much AI, and we've maybe over-indexed, and there may be that pullback. And I think, but I think where, to your point, because it's so easy now to spin up an app, I think we are going to be flooded with lots of products trying to do lots of different things. I think you've just got to be incredibly discerning about what you choose to let into your.
That was one of the first thing, again, probably from the background where I come from. The first thing, and I'm not against AI. AI can do fantastic things, like the dashboards I'm building with Claude. Oh, beautiful. So I still have the spreadsheet, but it makes it,
makes it actually
very visible,
pretty
very
visible
nice.
and usable.
Yes.
Yeah, sure.
So I'm not against AI at all in general, but when all of this came up and I saw the capital in the market moving only to AI, whether it makes sense or not, my first thing that I always said to also still friends of mine that are working in the business, but what's the defensibility?
Yeah, sure, of course.
Think about that for a second, please. Just for the love of your fund and your investors, think about the defensibility of your business. And if it's AI, fantastic. If it makes sense, sure. But you need to make sure that if someone else vibes coded on a weekend, that this business is still going to make it compared to the other one, that it's now cheaper and prettier.
Two things I would say to that in agreement and in response. So I had a conversation with a few deep tech investors recently and just more generally VC investors. And like, we're all incredibly excited about deal flow has never been greater, right? Like you can build anything at any point. But that discernibility question has become harder. In deep tech, one of the investors was telling me we're seeing like just potentially incredible stuff, but it's become harder and harder to discern what is going to be a business versus what is just an interesting, cool idea or whatever. And again, with software, more generally, the death of SaaS, whatever you want to call it, with AI, is it the obvious one is it just a wrapper over an LLM, in which case there's zero defensibility, but equally, right? Like, so if I think about financial, like CFO services, etc., at the moment, my LinkedIn is flooded with, I just replaced my CFO with Claude. Here are the 9 prompts. Does a massive disservice because actually those prompts are not what a CFO does, but fine. But the point is that some of these foundational models are just accelerating at such pace that actually what was defensible yesterday isn't today. And I've talked about it a few times on the podcast, like the things that I think are really defensible today are distribution, proprietary data, and hardware. Like those are the 3 moats that I think still persist because capital is no longer
ironic because no one wanted to invest in hardware 5 years ago.
Software was eating the world, right?
Yes.
And then Andreessen moved to build or whatever it was, right? But yeah, look, I think that kind of move from bits to atoms and now bits that enable atoms, I think is the next story. And then once quantum comes into play as well, that I think that that singularity, if I can put it that way, I think is gonna lead to some really interesting stuff. But yeah, I think it's become a tougher environment for VCs and for founders, right, to figure out how to stand out, but also how to tell that narrative of why this is going to be a massive company that is defensible in the long term. Finally, so that we can get to know the real you, what is something that moves you emotionally?
That's such a hard question. I mean, of course, I'm talking to people every day. So as I said, this contact to my users and having these conversations are extremely important for me right now still. So my solution might be automated and technology is nice and beautiful and hopefully helpful most of the time. But ultimately, these are real people and they're talking and telling me real people's story where someone lost a job, someone lost a family member or loved one, just the struggle of how complicated life is in general and finances in particular, or, and this moves me every day, yes.
Yeah.
Sure.
Human stories, I guess. Right?
Exactly.
Like the reality. And again, not, the risk of repeating myself. I think actually with the proliferation of AI, what we're going to see is a real return to the value of that human interaction, really understanding people's narratives, their stories, and that human connection, which I think actually to your point around, is software helping us or is tech helping us anymore? That's part of the problem, because we basically abstracted away from the human, made everything kind of robotic.
Yeah.
And I think people are feeling that now. And I think feeling it more than ever, because there is just so much uncertainty kind of happening everywhere.
And I mean, it's probably ironic that I'm saying it with an automated solution. That's what I'm doing. But I'm literally, my customer service team, they know I'm telling them we do not push our product on people that don't need it.
Yeah.
Because it's finance. This is the life of a person that can be destroyed by something that is not correct.
Yeah.
And we make sure that people we try to make sure people understand what they're getting into and make a product that then actually works for them.
Yeah. And you're solving a real pain point for a lot of people, right?
Yeah.
And I think that is the thing. You're not just selling kind of a dashboard on on a Excel backend or whatever passed for B2B SaaS 5 or 6 years ago.
What moves you?
Wow. Okay. Haven't been asked that. What moves me? Lots of things, but very much human conversations absolutely move me. There are certain music moves me incredibly, as does writing. I love reading, and some of the things that I've read have always moved me in multiple ways. But the thing that actually moves me the most, at least visibly, or I've noticed results in a physical response from myself, is anything where I see people being treated as as underdogs, right? So it really weirdly, I will watch, you may have seen the reel of the young politician in New Zealand who does the haka during Parliament in response to I mean it's incredible, but I find myself actually welling up when I hear kind of music from Africa, from India, often overlaid over kind of really, really difficult stories. I think that I find that really tough. So yeah, I think. But if I were to distill it into one word, it would be humanity. Having that connection with and being human is definitely what moves me. Thank you very much for asking.
Yes, of course.
This has been an absolutely phenomenal podcast. Thank you so much for joining me, Laura, today.
Me.
For our listeners, where can they find you online? Are you on LinkedIn? Are you on Twitter, X? Where can they find you?
Yes, all of the above. Well, not on X actually, but yeah, I'm on Instagram, TikTok. I have a homepage, LinkedIn, etc. If you want to connect with me, then also just reach out on LinkedIn. I still reply. Amazing. I occasionally do. Absolutely fantastic having you in the studio. Thank you so much for joining me. Thank you.